Hi, I'm Alfredo Perez,
And I'm Julio, Virgen.
and today we're going to be talking about the financial analysis of Verizon and AT&T. So to start, who are our shareholders? When looking at these two firms, we saw that Verizon is held by 68.38% of ownership institution compared to AT&T's 55.75%. In the 2017 year, Verizon had 4.13 billion shares outstanding compared to AT&T's 6.18 billion shares outstanding. Both of these companies have similar shareholders, their top three being Vanguard, BlackRock, and State Street for both of the firms.
Investors care about cost of capital. It is because it can help investors evaluate investment options to maximize their return. Investors use this data to see how a company finances their operations, and companies can put investors at risk if they mismanage their finances. Some advantages of debt are tax savings because interest expense is tax deductible, and however, some disadvantages are agency cost, where debt exposes a firm to conflicts between shares and bondholders over investment financing and dividend decisions.
So next we have what is our cost of debt financing. So with this we have two parts. We have the pre-tax cost of debt and the after-tax cost of debt. Pre-tax cost of debt is the amount of interest paid on a loan without tax deductions, which is found by adding the default spread of bonds to the risk-free rate. So both of these companies have a BBB rating, and so we took that rating of 2.5% and the risk-free rate on December 31st, 2017 of 2.4% to come out to a pre-tax rate of 4.9%. Next is cost of debt is the interest rate of debt after deducting income tax and tax savings. The tax cuts didn't take effect until 2018, so both of these companies are still paying 35%. So we found this by taking the 4.9% times 1 minus the 35%, and they both came out to 3.18%. So neither company has an advantage over the other.
This is our cost of equity financing. We found the cost of equity by using the capital asset pricing model. We calculated the risk-free rate by estimating the long-term bond returns, or the U.S. Treasury bonds, and the market risk by using the geometric mean and taking that against the historical stock market returns minus the long-term government treasuries. And lastly, we found beta by regressing the company's returns against the market. And we found that Verizon's cost of equity was 3.82%, and AT&T's was 2.39%. And we would think that AT&T has a better position there.
So next we have what is our overall cost of capital. So with this, it's important for firms to evaluate this because of future expansion and acquisition projects. Companies want to see that their expected rate of return is greater than their weighted average cost of capital. So here we see that the weighted average cost of capital for Verizon is 2.65% and AT&T is 1.95%. So with that, we see that AT&T has an advantage when it comes to terms of investments and wanting to expand.
So can we lower this by changing our capital structure? Both companies can exchange debt for equity and move towards an optimal capital structure. This will lower the cost of capital, and this will benefit both firms by having more leverage in financing decisions. Doing so would benefit Verizon because they have a lower cost of capital.
So next we have how would a financial restructuring affect the value of the company. So here for Verizon and AT&T, we see that their current debt ratios are 42.04% and 51.09%. So with the enterprise value of Verizon, it's over $378 billion, and AT&T's is over $321 billion. If they were to both go to optimal ratios of 30%, it would increase the value of both of these enterprises. It would increase Verizon by $8.3 billion, and it would increase AT&T by $1.8 billion. In this case, Verizon would be better off restructuring. What does the competition do? So here we chose two other competing firms. We took Sprint and T-Mobile, and we analyzed their current assets and liabilities and how they compare to the two firms that we are analyzing. So we see here that Sprint is more weighted on long-term investments, as T-Mobile is more weighted on cash. We see that Sprint has more cash than Verizon, and T-Mobile's kind of spread across between cash and long-term investments. Next, we see that neither of these companies are really heavily weighted on long-term or on current liabilities. They're more invested in the long-term debt, which means that can be anything from investments to acquisitions and such deals such as that.
Our stock price is fairly valued. Currently, Verizon stock price is at $52.93, which is below the intrinsic value analysis that we concluded of $53.93 per share. This would suggest an overvaluation of the firm as of December 31st, 2017. On the other hand, AT&T's current share price is $38.88 per share, and through the analysis, we concluded it should be $29.54 per share, which is an undervaluation. So at this point, we would select AT&T as the firm to invest in.